Okay, we're going to go ahead and get started. So hello and good afternoon, everyone. I'm Kyle Hill, one of the partners here at Diversified, and I'd like to welcome you to the next installment of our Wealth Webinar series. This session is the investment Q&A with our Chief Investment Officer, Michael Horwath. So for those of you that don't know, Mike has been with us for about 5 years now. Started as our investment specialist, and for the last 2 years now, he's been our Chief Investment Officer. In that role, Mike's job is to head our internal investment committee. He's responsible for the investment direction of the firm as well. So with that, I will allow Mike to start here. What he's going to do is give us a brief update on where the markets are, and then allow for the Q&A. But in the meantime, go ahead and start sending your questions in so we can have some of those queued up and ready for him when we get to that part.
Perfect.
Away, Mike.
Thank you, Kyle. So first off, thank you everybody for hopping on. As Kyle said, my name is Mike Horwath. I'm the Chief Investment Officer here. My role really is behind the scenes for the most part. It's heading up the investment committee. It's making the decisions around our philosophy, our process, and ultimately the implementation for all of the investment portfolios of the firm. So we appreciate everybody taking a few minutes here. We thought it'd be a good idea to do a kind of just an open mic or Q&A with anybody who wanted to hop on and take a few minutes out of their day. So if you have questions, feel free to pass them along. Kyle will take a look and he'll moderate and make sure he passes them along to me. In terms of where markets are, we're at an interesting point. I feel like I say that every time I get together, but it's always an interesting point of, global markets are up 14, 15% this year. There's been this continued recovery in equity markets. Bond markets have struggled a little bit due to a lot of uncertainty around where rates are going to go. You're going to see a lot of news today around the Fed and what expectations are there. But the Federal Reserve is ultimately driving a lot of the movement in markets and a lot of the movement, especially within bond markets. So we'll, happy to address any of that or any concerns there. But where we stand today, we stand at an inflection point where we expect economic conditions to continue to recover. Conditions have really done well, really since the middle of 2020, after that really strong pullback, really strong lockdown where markets struggled, where a lot of economies and industries were done, or at least shut down for a little bit. Things have recovered very well. Unemployment continues to recover, corporate earnings continue to recover, but realistically, we're at a point where stocks are very expensive. There's a lot of optimism priced in. So there's naturally a lot of concern about what people are willing to pay for stocks. Where do I want to be positioned? So we need to really, be cognizant of all of those conditions and really think about how we construct both our equity and our fixed income portfolios moving forward. So I'm happy to take any questions specifically around certain topics, and I'll flip it over to Kyle where we can kind of get started.
All right, so again, keep those questions coming through, gang, but we do have a couple here to start with. So first, Mike, one that came in says the Federal Reserve's been very active with monetary policy over the last decade. What's their next move, and how does it impact markets?
Yeah, so I think it's easy to forget how much what the Federal Reserve does influences markets day to day. So as a reminder, the Federal Reserve is the central bank of the US. They really control short-term interest rates. They control some of the asset purchases, which means they can go to markets and they can either buy or sell bonds and try to either increase or pull out cash into the market. So either flood or pull cash out of markets. It's their way to manipulate markets as well as they can to influence really two things. Their goal is to influence low unemployment, right? So their unemployment target probably say 4% as full employment. So they really want to continue to bring down unemployment, but they want to moderate that in the same context with low positive inflation. So their target has historically been about 2%. So when you think about that in the context of what they're trying to do today is they've dropped rates to the floor. So interest rates are at the floor. They are buying bonds like crazy in the market to the tune of, I believe it's 80 billion a month. So they are doing a ton of active monetary policy. What we would call is accommodative, right? So low interest rates and asset purchases are designed to influence the market to spend money, to borrow money, to influence cash in markets so that you stimulate the economy. What that also does is it keeps interest rates very low. It's hard for people to save money and earn any money on a savings account at the bank. It's hard for banks to earn money because their net interest margin on what they give to savers versus what they can loan money out is it's a tough dynamic there. But in the end, their objective is to moderate unemployment, keep unemployment low, keep inflation low, but positive. So what their next move is to continue to monitor the economy. And at the end of the day, the next move is to decide to taper their asset purchases. They're not going to go from buying assets in the market to buying none. What they're going to do is what's called tapering. They're going to slowly reduce the amount that they do over time. They've said that they're not going to raise interest rates because that's ultimately what gets talked about most is when are they going to raise interest rates? When are mortgage rates going to rise? When are savings account rates going to rise? All those little things. They're not going to raise short-term rates, likely until they're done tapering those asset purchases, which will likely take 8, 12 months. So expectation would be that they'd start that process end of this year, early next year. And that would time up to the next or the first really rate increase from the Federal Reserve towards the end of 2022, beginning of 2023, which is probably the more likely scenario. How that influences what we're looking at, I think you have to be realistic that bond portfolios are going to yield lower rates or lower income for a while. I think it's also a dynamic though where you would expect corporations to take on some debt. It's very low. It's easy for them to refinance or to take on debt at low cost. You would expect that mortgage rates remain low. So for the context of portfolios, we just think it's going to continue to be a very accommodative policy for a while that should allow stocks to continue to perform pretty well, at least not put them in a position where they're going to pull back overly too much. So that's how I would think about it. I think you have to not only think about what the Fed's going to do, but what that then does to your portfolio and the second order effects beyond that.
I got another question here, more specific around stocks. So what is your case for sticking with the stock markets at current price levels?
Yeah, so current valuations are not cheap. So when I say valuations, I mean the amount of money you're willing to pay for a stock based on its underlying fundamentals, whether you want to use its earnings or its book value or anything along those lines. There's no doubt that stocks are very expensive. Based on historical figures, they're trading, maybe 20, 30% more expensive based on those multiples. The reason that they're willing to do that is a couple of things. One is the Fed's going to continue to be very accommodative. We just went through it. They're going to keep interest rates low. You also have to look at the federal government. The federal government has not shied away from spending money and throwing stimulus at the pandemic and the issues there. So between all of this stimulus from 2020, along with this infrastructure bill, fiscal stimulus has been very strong, and that should help drive some economic stimulation right there. And really, when you look at the consumer, I think that's the other side of this, Kylie. Consumers drive this economy. Consumer spending is 70% of GDP. I've said it, say it till I'm blue in the face. We are a consumer-driven economy, and it's vital that if the economy is going to continue to push forward, that the consumer has to be comfortable spending money and they have to be confident to spend money. And we do see that. We've seen some blips with some consumer confidence dropping recently because of the Delta variant, but savings rates are very high. There's a lot of cash on the sidelines. There are a lot of people who are waiting for opportunities in markets. Now, some of that may be they're waiting for markets to pull back, or they're waiting for other areas or pockets of opportunity to throw money into markets, but there's a lot of money on the sideline. The consumer is very healthy. The US household is very healthy. Our debt to income ratios are very low compared to where they were back in 07, 08. Economic conditions from a corporate standpoint are very strong. So when we look at all these facets of an accommodative Federal Reserve, an accommodative fiscal government and fiscal policy, a healthy consumer, household debt's pretty low. All of these line up to a stock market that should continue to be pretty healthy. We think it can be bumpy. There's no question that headline risk is there, that You never know what happens with the pandemic, but from an economic standpoint, there's a good case to be made that stocks are going to continue to push forward. I think it just does matter, and people need to be cognizant of the prices you're willing to pay, because stocks don't just continue to go up beyond any price, right? There has to be fundamentals behind it, and stocks will always over time revert to their fundamentals. So it's be cognizant of what you're paying for it, lean into opportunities or areas that are relatively cheap that have good opportunities moving forward. And that would be my best case, keeping a high level with regards to stocks.
I had another question that came through that said, fixed income has not done very well over the last 7 months. How long do you think this may continue?
I think expectations are important with fixed income right now. So the next 10 years, when you think about capital market assumptions, when you try to predict out asset returns, an important part of that is, where are you today? What are the prices you're paying today? Bonds are expensive. So that is really where the struggle has been, is people had bought bonds, and investors who had invested back in the 70s and 80s knew of the interest rates and the yields that you received on your fixed income and your savings rates. That has been in just a 30, 40-year decline. So where we start today, I do envision that fixed income is going to be a little bit challenged. And what we're looking to do is avoid some of the areas that are going to be most challenged. US Treasury bonds are going to be probably the most challenged because they're the most expensive. They're also the most manipulated, at least in the current context of what's going on. So we're really remaining diversified. We're looking at areas in the corporate bond sector. We're looking at some of what we call plus sectors. So they're areas that come with a little bit more risk within fixed income, like high yield corporates, bank loans, debt of emerging market countries. We're not putting sizable amounts of our fixed income portfolio there, but we're looking at small allocations to, one, add diversification, increase our yield, and they also have higher expected returns. So those are things that we have to look to do. The other expectation that people need to keep in mind, and investors need to keep in mind, is that you don't buy bonds to outperform stocks. Bonds are safer than stocks because a bondholder will get paid back faster than a stockholder would in the case of a bankruptcy of a company. That's really the concept behind why bonds are safer than stocks. You don't buy them to outperform stocks. So even though if our expectation is low single-digit returns or low or mid single-digit returns over time, that's okay, because what you're buying is the diversification benefit. The reason why people buy treasuries at a time like this, when the Delta variant has picked up, is the similar reason why treasuries performed very well back in February and March of 2020, is because that's where people flock to. It's protected by the government of the United States. So at the end of the day, you're buying the diversification benefit. You're buying the protection that if markets pull back, that your uncorrelated asset in that US Treasury bond is going to hold up well, if not appreciate in value, because the demand picks up. But that also has to be kept in the context of, when you look at a stock market that we've seen that's up 15, 20%, you don't expect bonds to keep up. They're not going to. They're there for diversification. They're there for stability. They're there to protect investors if something happens with stock markets. And they're really there as our ballast to control the risk in your portfolio. If you're not concerned about the risk that you're taking, you can be all stocks, but most investors aren't. There is that element of, I need some diversification. I need some protection from stock market risk. And that's where we can lever our bond portfolio. And look, like I said, we're not going to be 100% treasuries. We're going to diversify it. We're going to look for opportunities in the same way we look for opportunities on the stock market. But the expectations need to be clear that, yes, interest rates are very low. Interest rates are going to rise. That is a headwind for fixed income, but we don't buy bonds to outperform stocks, at least over the long term. They just come with less risk. So we take less return because we're taking on less risk. And that just needs to always be kept in the context of the overall portfolio.
Got another one here. What do you consider a retiree's or soon-to-be retiree's biggest investment challenge?
Yeah. Retirees, there's a lot. There's some from your end, Kyle. You guys come across from a planning standpoint where pensions are going away. So fixed income or your defined income in retirement is going away. I think stock market and bond market prices today and what the expected returns are based upon how expensive things are today. If you retire today, your expected returns are substantially lower than they were a decade ago for the next 10 years. So as a retiree, you need to be forward thinking about what are expected returns, how do we diversify a portfolio? And I think really the biggest concern comes into where interest rates are. Interest rates are so low that you can't have a savings account that earns substantial interest, right? You don't have your fixed income from a pension or something like that. So you have to create your own pension. A challenge is going to be, we have to be very creative. We have to be forward looking. We have to be opportunistic in markets so that we're not just buying US Treasury bonds and expecting them to give us the return we need from our fixed income portfolio. So I think it's the starting point that we have today in stock markets and bond markets. Things are expensive, and the best predictor of the next decade of returns comes where you're starting, right? Where your starting value is. Things are expensive. So, our job, and we talk about it every day, I talk about every week in the investment committee, is how do we drive returns? How do we look for opportunities? How do we do it in a controlled environment from a risk standpoint? And that's what a retiree has to think about is how do we position our portfolio? How much risk do we want to take? And how do we, make sure that our cash flows and all of our goals that are designed, to come from our portfolio are going to be accomplished, based on our current starting value.
Another question that relates to diversification here, specifically international investing. So China recently added several regulations that rippled down through the markets around cybersecurity, monopoly type behavior, even after school tutoring. How do you view this move, and is it still worth investing in China?
Yeah, international investing is an interesting one because for the last decade, international has underperformed domestic. So if you're a domestic investor in the US, the argument is, well, why would I want to own any international equities? There is, in our opinion, a case to be made that owning some international, so owning some emerging markets has some viability moving forward. And I understand a lot of this comes down to the political angle because China does things differently than we do, and it creates tensions. There's always the two biggest economies go at each other from a trade dispute, at imports versus exports, chip manufacturing. There's a lot of things that there's just tit for tat. So they get a lot of headlines. But when we look at how do we drive returns, we just spoke about how do investors drive returns moving forward. And when you look at the expected returns over the next decade by asset class, emerging market stocks have the highest expected return because of where they're starting and the expected growth rates within emerging markets. And when we say emerging markets, we're talking the BRIC countries, Brazil, Russia, India, China, South Africa. So the growth rates in those countries are expected to be still substantially higher than in the US. There's this drift to the middle class, right? So the middle class is becoming wealthier. Those countries are drifting now from these manufacturing heavy. You look at China, the biggest companies in that country are technology firms, Alibaba, Tencent. You talk about the biggest chip manufacturer in the world, Taiwan Semiconductor, right? These are the tech firms that are driving growth within these countries. But at the basic level, if we're trying to drive returns in our portfolio and you look at what's got the highest expected return over the next decade, it comes down to emerging markets having the highest expected return. We're not going to ever put 50% of a portfolio into emerging markets. There's just too much risk and we don't see that benefit. But having a small allocation and thinking about where you're trying to allocate your capital to drive growth, we do look at it as an opportunity. We also expect, look, the US is running fiscal deficits. We continuously run fiscal deficits and we're pumping a lot of money into the economy at a faster rate than most of the other countries in the world. So what happens when you do that is that your dollar is going to depreciate in value. When you depreciate your dollar, international stocks get like an automatic headwind. So that should also help the international markets. But we look at it from a couple of different angles. We just spoke about the opportunity from long-term return expectations. We look at it from the growth in the middle class and the demographic change within emerging markets, and it's also a diversification benefit. Emerging markets and international stocks like Europe, Japan, some of those developed countries, they don't work lockstep with the US. So not being perfectly correlated adds a little bit of diversification. If the US were to see any sort of pullback or any sort of hiccup, it does provide a little bit of that buffer, a little bit of diversification benefit. But in the end, we look at it as just an opportunity. We still think we have to be smart about it. We're not going to ever put 50% of our portfolio into international. At least I say that today. Maybe I'll put my foot in the mouth at this point. But in the end, we do see some value. We try to always look at it from a kind of an independent view of just where can we drive returns for our investors and where can we do it prudently in a risk-adjusted way.
Love this next one, Mike. So there's a lot of talk about Bitcoin and cryptocurrency in general. What's your opinion on the potential for crypto, and should it be part of a client's portfolio?
So crypto is a tough one. So I understand the excitement. I understand how different it is and the idea behind it. So if you read the original thought piece, right, the original white paper, it's a very interesting concept behind what the idea behind blockchain technology was and a decentralized currency. And the idea of a global electronic currency sounds great, right? We all use the same electronic global currency. Everybody uses the same thing. It's not the euro versus the US dollar. They move, nothing's backed by a certain asset or like gold like it used to be. However, in practicality today, it's very speculative. Investing in Bitcoin, I hear different arguments and nothing ever comes to a single argument other than it's speculative, right? People think that there may be a place for it in the future. So we're going to buy it today because if there is a place for it in the US or the global economy, that the value at that point will be higher and I'm going to look to make money off of it. That's very speculative. I can't predict anything around Bitcoin, right? If I look at Amazon, I can tell you what the company is, what they do, what the industry looks like, what their marketplace looks like, what their earnings look like, project out their earnings growth. You can discount those earnings back to give you an idea of what their stock price should be. That's how stocks are really priced, or fundamentally should be priced. You can't do that with Bitcoin. There's no cash flows. It's just an electronic currency. I think investors, if you're interested in it, there's a lot of different ways to access it. You can go buy Bitcoin, you can go buy Ethereum, you can go buy Dogecoin, something like that. You can also buy ETFs that track companies that are focused on blockchain technology, which is an interesting idea. But in the end, I think people should look at it like a speculative type of investment, right? Something that's more play money, because anything that moves with the volatility that Bitcoin does on a daily basis probably doesn't have a really, or shouldn't have a really big place in a retiree's portfolio. It should be looked at as a more speculative long-term growth. I think it's an interesting conversation, interesting concept. I always like when markets are kind of pushing themselves to change, and this may fail in the long run, but I think it's interesting. But at the end of the day, I think people should look at it from that context, not from the standpoint of it can move 20% in a single day. That type of movement cannot be part of a retiree's portfolio, especially when we have very hard challenges to create any realistic expectations moving forward for what Bitcoin is and what its place is in the future.
I think we have time for one more question here. So inflation has been all the talk recently in the news. Is it a legitimate concern or is it transitory?
Yeah, inflation. So inflation, there's no surprise to me, and the expectations were that inflation was going to rise because of really three primary reasons. One, things fell for the most part price-wise in 2020, right? It was a sort of deflationary type of environment. So the way inflation is typically calculated is they would compare July of 2021 versus July of 2020. If your starting place is much lower, even if the prices get back to where they were previously, you're going to see an inflation jump. That's called a base effect. You're going to see that phrase every once in a while when people try to explain it. But it's just the fact that 2020 dropped in prices, at least certain industries did. In 2021, things are recovering. So naturally, you're going to have this year-over-year rise. You're also going to see this pent-up demand. A lot of people want to travel. A lot of people want to do things that they haven't been able to do for 12, 18 months at this point. So there's this pent up demand, pent up savings that people haven't been able to spend on traveling. They're going to go deploy that capital. And then there's supply issues. You hear it all the time with semiconductors. Car manufacturers have a very difficult time getting chips. They can't produce cars. So there's this high demand for used cars. And that's been used cars prices have risen quite dramatically. And it's because, new cars just aren't being able to be produced at the same rates. So the demand effects, the supply effects, and this base effect have all driven what we see from an inflation standpoint. All in all, I think the inflation levels that we've seen recently are transitory. I think when you look at the figures and underneath the hood of what's driving those prices, it was a lot of these industries that have been hit by supply chain issues. So, in the end, we do think those are going to subside as eventually this pandemic starts to hopefully go away. I think we all really hope that sooner rather than later. But as supply chains eventually start to get better, as things are able to be manufactured quicker, and our input costs start to drive, because that's the other issue. Input costs have risen, and that either means earnings are going to drop for the company or they're going to pass it along to the consumer, where inflation would rise. We do think that'll subside. And a lot of the areas that have driven the inflation recently have been areas that we would expect are transitory. So, long story short, we expect it to be mostly transitory. That's aligned with what the Fed believes. A lot of the economists that we follow, we speak to, that's what they believe. Doesn't mean inflation is going away. It doesn't mean that 2.5% inflation is unreasonable. We still, I believe, look at 2 or 3% inflation when we create our financial plans. We still think that's very reasonable. We don't think 5% is sustainable, and it's not going to be sustainable over a long period of time, and that'll start to subside.
Mike, you want to do one more here? Looks like we did
Sure.
a couple more that came through here.
Of course.
Any thoughts on investing in real estate through platforms like Fundrise as part of a diversified portfolio?
Interesting. I'm not 100% aware of Fundrise, so I'll speak a bit more from real estate in general. So real estate, we've seen it's had a nice run. I think there's a couple of different aspects of physical real estate that are really nice. One, physical real estate does a really good job of keeping up with inflation. In a time when interest rates are low, you can certainly have access at very low interest rates and low capital. You see that just people from primary residence, right? Not necessarily investing, but from their primary residence or secondary residence. Real estate, I would be a little bit careful on real estate, because I still think you have to be picky about where you're going to look to buy. Reason I say is, look, there's no doubt that low interest rates across the board have driven a lot of people's willingness to pay more and more for their home prices. As interest rates rise, as they will rise, we expect at some point the rate of growth that we've seen from real estate prices is going to drop. I think there's an interesting dynamic within commercial real estate, because it's really an asset class right now that's looked down upon because of the pandemic, this work from home. You see me right here, I'm working from home. People, some industries are going to continue to work from home permanently, or there's going to be some hybrid environment. So corporate real estate is a little bit of a concern. So for me, the race and rise that I've seen from real estate, I think you get some of the inflationary protection, you get a true diversifier. I think physical real estate gives you much better diversification. If you look at the numbers, a physical real estate allocation versus buying something like the stock of Prologis or something like that, or buying a REIT or something like that, you're just not going to get the same type of diversification, the same type of differentiated return. So I think physical real estate has a place for investors who can allocate a small percentage of their portfolio and access physical real estate. I just think based upon where interest rates are, where we expect them to go, the prices today, I would just be careful about how much anyone's putting into real estate within their portfolio and the size of that allocation within their portfolio.
Thank you, Mike. So with that, I think we've hit we wanted to keep things to about a half hour today. So thanks for spending your time with us. Just as a reminder to everyone, we did record the webinar. We'll have it posted on our website for easy access. And as always, please feel free to share it with anyone. But on behalf of Mike, myself, and everyone else here at Diversified, thank you for attending today.
Thanks, Kyle. Yep. Take care, everybody.